Hedge funds have the luxury and flexibility to make money in a variety of market conditions, up or down. The KADD Capital Validus fixed income hedge fund has achieved an annualized return of 22% over the last 5 years. Here to give us his secrets is Kevin Pretorius. Kevin, I don't know if I've got the name. It sounds like a Latin name. Did I get the pronunciation right there?
That is correct, yeah, Validus.
So it always seems like such a sexy industry from the outside in, the hedge fund industry, and one often thinks of it in terms of equity or macro funds. So you can also do it using fixed income instruments.
Yes, definitely. So the kind of instruments that we would use in our fund, we have a mandate to use any interest rate instrument. We would use things like bonds, so that could be both government and parastatal bonds. We could have derivative instruments, so that would be swaps and FRAs. Optionality, money market instruments like NCDs. We tend to have most of our fund invested in the derivative instruments, so more on the swap and the FRAs.
So you're a bit of a rocket scientist, really, because you know what all those acronyms mean and you can do the calculations quickly.
It's just there to confuse everybody. It's actually not that hard.
I think, Kevin, you guys have been very successful because you've traded in a space that many of the long-only fixed income funds don't trade in, and that's around some of the money market instruments. I think for the benefit of viewers, could you just tell us what exactly those instruments are, who issues them, and how you go about making money from those?
Yeah, sure. So, as I mentioned, predominantly we would trade in the swaps and the FRA market. The FRA market being a forward rate agreement. That is a predictor of where the JIBAR rate is going to be in the future. Now, JIBAR.
But these are all short-term instruments, right?
These are some of the short-term instruments that we trade in. So the JIBAR is the mid rate of the 3-month NCD, and then that is an average of all the banks that issue the NCDs. Excuse me. And so the JIBAR then, we then use the FRA rate to predict where that JIBAR rate will be in the future. And the JIBAR rate is very closely linked to the repo rate. So today's MPC decision for us is crucial, as we then see if the Reserve Bank's forecast is in line with ours and our prediction on where repo rate will be in the future.
So would it be fair to say that you kind of build your own models around inflation, economic growth, and you take a view, if you're trading these instruments, and especially if you're going to be holding them across an MPC decision, which comes into effect immediately, it's obviously important that you have a view that's in line with the MPC, because you would trade on that view. So in other words, what I'm trying to say is you need to make sure that your view is similar to the one that Jill Marcus stands up and publishes at every MPC. Otherwise, you might be facing a market that moves against you, in other words.
Correct. Like my colleague Donnie always says, he says MPC day is like test day. So, all the work that we've done, did we get the test right on the day? So like a day like today, we did quite well. We were very happy with the speech. It was a nice and dovish speech. It highlighted all the things that we are very, very concerned about. But she still left rates unchanged, which we were hoping she would do. We don't quite think it's time yet, but we do definitely think that there's possibly more interest rate cuts to come.
So typically, if you take a position, you've got a view, you take a position, how long do you lock yourself into that position, or is one free to change if you feel it's time to get out of that position, you can get out the following day?
It really does. It's what's called trade dependent. So we would have a few strategies that we would have on, where some trades would take advantage of the very short end space, where we think perhaps some of the FRA rates are misaligned to where we think they should be aligned, or the swap curve is perhaps a shape that we think is incorrect. The swap curve being more of a simple average of where JIBAR will be over a specific time frame. So that could be 2 years, 5 years, 10 years. And the shape of that curve. We could also use different instruments. As you mentioned, we can short instruments, we can go long instruments. So we would receive or pay an interest rate, receive the fixed or pay the fixed, and then try and maybe if there's certain gaps between instruments, hopefully those come our way and in that trade, but all aligned to our monetary policy view.
Kevin, you talked about some of the things that concern you, and one of the things we're seeing overseas, and we alluded to in the show already, is massive amounts of quantitative easing, which is basically the printing of money by central banks from the States to Japan. Do you have any idea what the long-term effect of this quantitative easing is going to be once you assume that the world economy starts to pick up and find its feet again?
Yeah, we're not particularly worried about the massive amount of printing that is going on at the moment. We think it's really needed. The world is deleveraging a lot. It has a lot of medicine to take, so it is, growing well below its potential. As well as South Africa, it's growing well below its potential. We would need growth to be above output for quite some time for us, to get back those jobs, to get industry going again. So we think there's more than enough time for those various central banks to pull in the reins, close off the taps a bit, because you would need sustainable growth for a prolonged period of time before we think that inflation becomes a problem. Inflation is not a problem right now.
So the risk is at this point more deflation than inflation at this point?
Definitely. Okay.
In terms of the one of the other things that's been quite topical for the local market is South Africa's inclusion in the World Bond Index. Many of the fund managers we spoke to, as that initial announcement came out from Citibank, who compiled the index, they said that a lot of the buying had been done ahead of the actual inclusion date.
Mm-hmm.
What's your view on what this means for the South African bond market?
Actually, we're not too sure that too much buying has been done. The flows that we've been tracking in conjunction with the offshore flows seem to match the EM flows right now. So we don't think that too much pre-buying has taken place. The big day is next Friday when the actual inclusion takes place, and even that is going to be an extremely interesting day. We're expecting about $1.8 billion, so almost 15 billion rands worth of bonds that need to be bought on the day. So it's going to be a very, very interesting day. See how that pans out. So we're going to be following that with great interest. So how this is what happens is mainly the Japanese tracker funds. They take up about 30% of this WGBI, the World Government Bond Index. They start their orders. They come through quite early in the morning, and the orders will then get built up, and we'll see exactly how much gets taken up. They then take all the bonds that they've put an order in for, and they get it on the close of Friday. So it's going to be I know National Treasury is going to be watching this with great interest as well to see how the demand goes on the day.
So there's obviously an implication there from for the South African rand in terms of this money coming in as well. Do you expect the 10-year bond yield, because it's the 10-year bond yield that is getting included in this index, is that right?
There's 12 bonds. They go from about 2 years right out to about 35 years, I think is the longest bond. The average duration is about 10 years. The various funds can either decide to strip out or buy each individual bond, which is, so the strict tracker funds, they need to buy every single bond exactly according to the duration and according to the nominal issuance of each bond. Some funds are not that sticky. They can perhaps just buy the one or two stocks that match the duration, it's quite close to the 10-year bond. Yeah.
Okay, so do you expect that the yield will move downwards as this money comes in to purchase these bonds on Friday?
Sorry, I didn't quite answer your question. We do. We think there's going to be substantial inflows, and we're quite optimistic that the bond curve should come down a bit more.
We've got about a minute just to ask you about draft regulation regarding the hedge fund industry. Now, how long have you been waiting for this regulation, Kevin?
A long time, and it's still a while coming. So they've made they've got a draft regulation. I think you've got until May to still make your final conclusion before it then gets submitted to Finance Ministry. They've got two options. They have got one for the retail space, which we're not too sure. That's not really our segment of the market that we're concentrating on. And they've got the restricted hedge fund. That looks to be like no real change to how current hedge funds operate. So we're quite optimistic that there's no change there. Mm-hmm. But then hopefully we do get the retail space opening up as well.